Good day, everybody. Welcome to the Deal Scout. On today's show, we're going to have a conversation with a professor of commercial real estate finance. He runs his own consultancy. He's building some cool stuff for the future. And man, he's done $4 billion worth of deals as I'm looking through his, complex deals and complex debt throughout some of his journey. And I wanted to capture some of his wisdom. So, Mr. Patrick, welcome to the show.
Thank you so much, Josh. Thanks for having me.
Holy moly, you've got a lot going on, right? Where your family's growing and expanding, you're running multiple businesses, you're teaching people how to do it. If I met you in a coffee shop and I go, "Hey man, I'm Josh, who are you? And what do you do?" How would you respond to that?
Well, I'd respond just to how you framed it. I mean, I got a lot going on, but it's all synergistic. It all kind of plays off each other. I'm up at 5:30. I'm in bed at 9:30 unless I have to keep going and then crash. But every day it's a grind, and every day I'm always doing something different. So, but that's the real estate business. The real estate business is just one giant hustle. And I've been in the business for about 2 decades, and I've built a lot of background from an academic standpoint, but obviously had built a pretty healthy Rolodex. So that's all turned into a hustle where it just becomes fun. Every day's fun. Every day's different. New deal comes across. I have the ability to kind of pick up the phone or shoot out an email and probably get some good feedback pretty quickly. So I would say just that, she came into a coffee shop. I'm just out there hustling just like every other commercial real estate individual.
Yeah. Yeah. I kind of think of the world in buckets or umbrellas, right? Like someone's like, "What do you do?" "I build business." And they're like, "Oh, really? What kind?" Then I'm like, "Oh gosh, this is going to take a minute," right? We're in media, we're in commercial real estate, we're in finance, we're in this, we're in that. Like pick a day in what my grind's going to be. But I like, I want one big hustle, right? So tell us about getting the start in commercial real estate, like getting into it. How did you get into it? Because it's not an easy field to kick in.
Yeah, and I'll kind of tell you a little bit I'll tell you my story, right? Because I
Please.
always I kind of provide this, and I always look at this from the view of division, right? And I always look at it from the standpoint of finance is just from the simplistic standpoint, right? It's income over yield, right? And how I started in the business was really in the numerator. And what I mean by that is, I started out in the consulting and valuation world right before the GFC. Um, Market crashed. However, somebody needed a value, other values are going up and down. So I was super busy during that time period, but I was mastering the numerator, right? I was going through a bunch of different property types: office, multifamily, retail, industrial, but I did some niche and esoteric type stuff, skilled nursing, assisted living facilities, marinas, cold self-storage. But at the same time, I mean, all that was just kind of understanding how to put together a pro forma in each of those, doing market studies, doing feasibility studies, and just kind of mastering the numerator. Realized I didn't want to be a full-time appraiser, at least on the fee side of the business, and had the ability to go back to graduate school. And graduate school took me from Dallas, Texas, all the way to upstate New York, up at Cornell University. Did that from 2010 to 2012. Had an opportunity to do capital advisory down in the city. Never thought I was going to be a New York guy, but that's where I met my wife. That's where we had our first child. But point is I mastered the numerator, went back to graduate school. I was exposed from a denominator standpoint, right? So I need to understand how to put debt and equity together. So I did that while, down when I was in New York. And so the master of the numerator, master of the denominator, now you've kind of mastered the division. And it took a little while to get to that point, but I've become very, very lethal from that perspective. And my wife's born and raised in Louisville, Kentucky. So pandemic hit, we had a 5-month-old, packed up, went to Louisville, and I guess the rest is history. But it's obviously turned into, I'd say the most ideal role of my expertise is developing a real estate program. And that's what we're doing at University of Louisville. So a lot of fun stuff that's happened between there, a lot of successes, a lot of failures, but that's life.
Yeah. I've never seen it put this way, right? Like income over yield. Got it, right? But you look at as it like you looked at your life journey like through a mathematical lens, numerator over denominator, right? Like here's how we're going to approach this. I mastered the numerator, right? We got the idea of, the income side. Now we got to figure out the yield side. So
Right.
That's really interesting. I've never heard that. It shows me how your brain works. So you graduate school allowed you to really focus on the yield side of the life. If you when you're looking at a deal, oh my gosh, okay, when you're looking at a deal through this lens, uh, what are some of the things on each side, or top and bottom, that you look at that are the most important that maybe other people don't look at?
So that's a fantastic question, because there's a deal I'm looking at right now. It's it's in the recreational vehicle world. It's in kind of campgrounds and stuff like that, which is a whole other business. And there's actually REITs that focus on this type of stuff. And
Yeah.
I didn't know that 48 hours ago, but now I'm kind of diving into it. And somebody had come to me and said, "Hey, we're looking to do this RV park here in Kentucky." And I said, "Okay, well, that's interesting." And the first thing I said was, first I went through the numerator. I said, "Okay, well, what's highest and best use? You're out there shopping for dirt. You got to make sure that it's legally permissible, right? So you got to check the zoning code. And then you want to be tertiary, but you don't want to be too tertiary. We don't have utilities." So I approached it first from kind of the numerator perspective, and just understanding highest and best use and finding the appropriate site that would fit, an RV park. And then the next thing is, okay, well, you got to buy this thing correctly. You have to satisfy both the debt capital as well as the equity capital. Who are the investors in this? So I guess, sometimes I approach the denominator first and then I attack the numerator, but those are kind of the first things that kind of popped into my head, was just what site can you find? Can you build it? And after that, where can you raise the money? So we still got a lot more boxes to check, but I've already blasted out several emails. I already have a few phone calls lined up, and that's kind of the beauty of where I sit now, is I can get these questions answered. So that's kind of my process. But I guess just to go back to your point on, I summarize my life. I summarize my career, but I tell you, my personal life is a little bit more of a free spirit, because, I started in Dallas, Texas. My father worked for Fidelity for 20 years. Fidelity took us up to Boston. I was in New England for kind of the back half of my youthful year. And then we went back down to Texas, and then I go back to New York, and all of a sudden I'm here in Louisville, Kentucky. So people hear about my life story and they're like, I didn't plan it, you know what I mean?
Yeah.
And I'm as happy as can be. And sometimes you just got to kind of roll with the punches, but I definitely knew my career. That's kind of how I wanted to approach it, was just mastering the division.
You went from cowboy boots in Dallas
Sure.
to Boston Scallies,
Yeah.
to back to Dallas, to New York and sports coats, now to Louisville, back to cowboy boots. Man, your wardrobe must be very unique with all those different changes.
Not as bipolar as you would think, but after the pandemic, now it's just a white or blue shirt, a jacket, which I got hanging back here, and just some khakis.
There you go. So you have your consultancy. Tell me about what your consultancy focuses on, like with your expertise. Like, what problem are you solving?
Well, I think you just put in the vacuum that it's an extremely turbulent time for the world in general. But you see more volatility right now in the treasury market than you do in the equity market. So something's goofy. Something is just not working correctly in the financial markets. And I think that kind of gets into a point where it's just like, well, where's the price discovery happen when you don't know how to build up a discount rate? You don't know what the real risk rate is. You don't know what the Fed's going to do in a month from now, right? Is it going to increase rates, decrease rates? And then we don't know what the expected inflation premium is going to be. So there's so much volatility that's happening. So why I say that to say this is just an opportunity that kind of came to we're still kind of negotiating the engagement and whatnot, but they need some counseling on just underwriting certain deals. And I can't tell you about the portfolio, but it's a high profile. I mean, it's a very legitimate portfolio by a very legitimate owner operator. But the question is, for some of these assets, it's just, what does the cash flow look like in 6 and 7 years? What do I discount that at? And there's appraisals that are floating around that I have to review, but appraisal business, it has its shortfalls. So I have a tool that I just bought that I actually used during my graduate studies called At Risk, which kind of, you use assumptions, empirical data to kind of perform the Monte Carlo simulation, and you can sensitize rents, vacancies. I'd say one other thing that people really aren't talking about It's starting to become more vogue, but climate change is having a significant impact on insurance, right? It's impacting the residential market, but now it's starting to really impact commercial assets. So, if you're in places where you're below sea level, right? What does your insurance premium look like in 5 years? Or if you're in California, right? I mean, obviously with the wildfires. So my point is in my consultancy, those are the kind of things that I attack, and I'm having conversations with insurance companies, and then I quantify it and put it into a pro forma, build out a DCF, run through a Monte Carlo simulation. Here's the things you can expect, and try to provide counsel on what your bid strategy should be. And then they make the acquisition, they recapitalize whatever they need to recapitalize, and then it's like, okay, well, let's go out and raise some capital and try and expand this portfolio. So I'd say it's two-pronged. How can I help you understand the real estate in a very volatile time? And there's plenty of dry powder that's out there. I think it's just, as we move to this new equilibrium value, I think there's going to be a lot of headache, but there's a lot of capital out there to kind of solve that. And spending time in Dallas and New York, I'd say they're a little bit more sophisticated marketplaces. Obviously, New York is the hub of finance. You come to other markets, middle America, and it's traditional banks. It's high net worth club deals. It's not the sophisticated structured credit that I'm used to. So I think there's a lot of folks that kind of need that type of counsel and those type of connections.
So when you talk about the dry powder out there, are you referring to like in 2007, 2008? Everybody was freaking out. Everybody's selling, prices were dropping and such like that. The people who were sitting on some money waiting for something like that to happen accelerated their wealth, and their buying power was massive. Do you think that dry powder is waiting for any type of massive change in the marketplace in terms of price drops?
Yeah, yes, I don't have the data points in front of me, but I've given this speech before, and we talked about just the surge in private credit, right? So
Yeah.
obviously the GFC changed the banking industry. You had Dodd-Frank, and you kind of had some changes that happened for regulated institutions, but you also had this flood of private credit that came from private equity companies, et cetera. And that hasn't gone down at all. It's actually increased, but they can think a little bit more outside the box. They can do things that regulated institutions cannot do. So I'd say that there's a lot of folks that are raising distressed funds, if you will.
Yeah.
And I've talking to folks that are bidding on kind of the Signature Bank portfolio that's out to market. I know folks that used to work at Capital One, and Fortress just bought their whole loan book. So nobody, everything's very confidential, so nobody really knows what price discovery is looking like. But there's going to be some recapitalizations because there has to be. Just the spike in interest rates, people just can't cover the DSCRs anymore if they're on floating rate debt, or maybe they bought some sort of hedge that's just way too expensive. There's going to have to be some sort of transactions that happen that kind of bring in that fresh capital. But it's not going to be cheap debt, or excuse me, it's not going to be cheap capital. And that's kind of one of the things that we're doing on the consultancy side. We're thinking about raising a fund. We're thinking about clubbing together some high net worths, and maybe finding a strategic LP that we can promote off of, et cetera. And we're finding those opportunities where there's a maturity wall. You can't retire at par based off cash flow, given where rates are today. And you need some sort of equity infusion, whether it's on the common or the preferred, to kind of help get you past this massive spike in interest rates. Because at some point, the Fed's going to have to cut rates. And I'd say the theme right now is survive to 2025 is what I've heard from some old school guys. But there's capital out there to help you get through it. So again, but if you're a vulture, if you're one of those distressed guys, there's a lot of folks out there are looking to buy, NPLs, non-performing loans, and we're not coming at from that aggressive standpoint. We believe there's definitely solutions to kind of solve the capital stack, because there's still assets that are performing. They're just having capital asset issues. So we're trying to target those type of deals, and so there's capital out there. There's ability out there to kind of get through this time, just to have the ability to access it, right?
Yeah, how neat. What made you decide to get into the academic world? So you're crushing deals, you're taking down big opportunities. You go back to Louisville, you put on a sports coat, and now you're jumping into the academic world. Why?
I started another long-winded answer.
Go for it, man.
when we decided to commit to Louisville, it's a town where everybody knows everybody, which is a good thing. A lot of smart folks, but I'm an expat. I have the New York twang. Like I got, I want to make friends here. You know what I mean? Like we want to build a family. So I knew that I had to kind of tap the community from a different perspective. I had to have, I had to be, you know, I had to contribute, right? And I had to kind of wave my flag in a different way. My father-in-law actually has been teaching at the law school for decades. And I said, Joe, let me see if I can't teach a class, either undergrads, MBA folks, whatever. And he put me in touch with the assistant dean. I kind of pitched him the class I wanted to teach, and he kind of made it happen. And I initially started teaching a real estate finance and investments course part-time. And I started teaching the class. It helped me with my public speaking. It helped me kind of hold the floor, which kind of helped me, on my professional side. But I really enjoyed it. I enjoyed it, reinforced some of the things that I had learned, but I was influencing lives too. I mean, I was shocked initially at just, kids was just like, that was one of the best classes I've ever taken. You gave me so much wisdom, et cetera. And I was getting that feedback frequently. So it definitely impacted me from a personal standpoint, where I was giving back to the community, but I was also I was inspiring students, and I thought that was just exceptional. So it became a part of my life where I enjoyed it doing it part-time. And now it came to a point where it's just like, I can make a lasting impact and some sort of legacy of teaching full-time. And I keep dropping U of L. Obviously, U of L is my day business or my day job. But I also taught at Rutgers University too. And U of L, it got out in the system, and I'm a CFA charter holder, and CFA Society in New York had a relationship with Rutgers. And then I kind of did my thing at Rutgers, and taught at Rutgers for a couple class sessions, and really had the same type of impact. So listen, academia, I will never consider myself an academic, but I love the ability to just kind of go out there and influence lives. And now I'm looking for students that had no idea what real estate was, but now they're inspired. I can help them get that internship. I help them get that full-time role. And what I'd like to see in 10 years is they come back to me and said, "You're such an inspiration to me." So I think it's from a personal standpoint, it really kind of touches my soul to really have that type of influence. But it reinforces it. But not only that, it kind of raises my standard where, folks come to me and they say, "Hey, you got your consultancy business." They want to look at me as an expert. And I think I can get in front of a classroom and teach and drive a program. I think it kind of really solidifies my expertise in the industry. So that's a bonus too. But at the core, it touches my soul. I have the ability to really influence lives, and I think that's pretty exceptional. And other teachers out there that don't get the same acknowledgement. I mean, there's teachers out there to do this, since they were, went to college, they've been teaching. I mean, it's such an underrated profession, and there's a lot of folks out there that influence lives. So we should acknowledge them too, right?
For sure. Absolutely. Before I became a firefighter, so when the market crashed it started for me in '07. I was on spec, so I was on the very early stages of the failure. I had to go get a real job. I got a government job, firefighter, medic, and I did that for a while. Before I became a medic, I watched some movies to see, man, could I do it? So I watched Backdraft and I did all that. Before you became an instructor, did you watch Good Will Hunting, Dead Poet Society? What's another one? Even like Catch Me If You Can. Like, did you watch these movies to go, do I have what it takes to be a professor?
So those movies you're talking about, Dead Poet Society. I mean, Robin Williams is tremendous in that. Again, Good Will Hunting. I guess you're a Robin Williams guy, but
I am.
Good Will Hunting, one of my favorite movies. So I don't know if it's I didn't watch him to kind of get inspired. I did it because just how I explained why I did it. But it's and there's other movies that they have, professors. I think it was that movie 21 where you had Kevin Spacey, who,
Yeah.
he
Talk
can
blackjack.
yeah, he can. Well, I mean, he was an MIT professor too, but
Yeah.
he can, and I've had good professors that really do a good job of holding the room. and you bring that to the professional world, you bring that to a negotiation table. Are you agile enough, but can you hold the room? Can you make that sale? So there's a lot of things that these professors do that just, hold the room, good delivery, and can teach a topic, and then you understand it. So yeah, I mean, there's not a specific movie, but I've definitely looked at professors that are influential, that I just say, man, that guy really holds the room. So
Yeah.
I try to get up there and hold a room.
You got to watch one more movie, Dangerous Minds, with Michelle Pfeiffer back in the day. If
Sure.
you want to, you look like Michelle Pfeiffer, you're going to hold the room's attention for a while,
There
especially if you're teaching commercial finance, right?
you go.
Yeah. All right. So I'm sorry, back to deals. As you guys are working through, you got your consultancy. I think, man, you are positioned beautifully for, what the world's going through. Cause I think we need, anybody could look at simulations or spreadsheets and kind of get a feel. And if you're buying stuff 2013 through maybe 2020,
Right.
an Excel spreadsheet could give you a lot of information, but there has to be a lot of what ifs that didn't come planned, like COVID,
Right.
like maybe stuff, the force majeures, the acts of gods that
Right.
are happening in the world. Through the consultancy lens, how are you thinking about those things? Like, how do you even know to bring those kind of risk to the table, and how do you prepare for those?
Well, I get just going back to the software at risk, right? And the things you're talking about from a statistical standpoint is kind of tail risk, right? Those are things that, we had a 100-year pandemic, right? We call it a 100-year pandemic because the last one was the Spanish flu that had such a significant impact on the world. And then, obviously we go back to like 9/11 and these type of issues that are not part of a cycle, you know what I mean? And it's that tail risk event. So if you have the empirical data to kind of capture those tail risk events, and you have a tool such as like a Monte Carlo simulation that can give you a statistical output and move you to a situation where your decisions are no longer subjective, they're more objective because they're based off a situation of 10,000 scenarios that bracket that tail risk. And then you can look at, okay, well, through these different confidence intervals, here's the most likely situation that can happen, but I've also captured the tail risk output as well. Right. So I think I think you have to approach, and real estate's not a statistical business just because you don't have it from a trade standpoint. But you do now we are accumulating the data that we need from an empirical standpoint to project rents, to project vacancies. We can do that with like a time series, but also that I think the business has become a little bit smarter where a lot of big data analytics
Mhm.
are starting to be quantified, and real estate investors, real estate investment managers, folks are really starting to look at data and how it impacts real estate a little bit more holistically. And that's what we're doing. That's some of the research that we're doing at Rutgers is how many more variables can we incorporate, not so much just in income and cap rate, but and one of our data partners is Trepp, and they went to publish an article that talked about obviously a relationship, a potential statistical relationship between crime rates and rents. Obviously, that's something that there would be a relationship. Obviously, it's going to have a negative impact. But the data, nobody's ever actually proven that correlation. Nobody's actually ever shown that lag effect. That's some of the research that we're doing now, is just showing what some of these big data analytics and how it impacts rents, vacancies, transactions, et cetera. So I guess again, a long-winded answer just to kind of say we're thinking outside the box, and we're bringing in tools that at risk is something that we did academically. I don't know any folks that wear an MAI or kind of have the same credentials that I do that are using it in their daily practice. But now when things are so volatile, I don't know how you could not use it in your daily practice, right? Because your opinion of value is going to change to tomorrow, especially if this war in Israel, or the Israel Hamas war, escalates. It could change the markets overnight. So, are you capturing that tail risk in your decision making? Are you offering that to your clientele? That's what we're doing, and we're embracing the volatility and providing solutions to help capture it.
What is the opportunity in volatility? Where should we be paying attention as deal makers?
Um, I'm not sure how to answer on the volatility standpoint, but I'll go back to what we're doing for we're going to go to market on a fundraise and we're clubbing together some money. But it's this maturity wall, right? It's this maturity wall that's happening not only in corporates, but it's definitely happening in commercial real estate. Barry Sternlicht, Scott Reckler's the CEO of RXR Realty, big owner operator up in New York. He was the one that was most vocal earlier this year, and he said this maturity wall is going to be gruesome. And what he means by not gruesome, but there's a massive maturity wall that's coming, and all that debt was financed at super low rates when values were at their peaks, and now that's all coming due when the exact opposite is happening. And he said 1.5 trillion. We actually have the data. It's 1.4 trillion. So that data is showing that he's correct. And we've done the analysis where we actually grow the NOIs from loan origination to maturity. We've actually done the amortization schedules, and we've actually quantified the equity gap for certain markets. And there's a significant equity gap. It's in the billions. We can't attack all of that. And the markets I'm talking about aren't even the top 20 markets. You know what I mean? So this volatility, I think, is going to create some distress. I think if you're on the backside of that to help provide a capital solution, I wouldn't say you're capturing the volatility, but you're being a little bit contrarian. You're saying, listen, there's distress coming. I got to be on the other side of it to kind of help provide a solution.
Yeah.
So yeah.
Explain for, you're teaching at a master's level and you're talking at a master's level, and I'm having to step up my game as a podcast host, because I'm like, oh man, my job as a podcast host is to ask the questions my audience has, but I have so many of my own questions, and I'm having to like really deeply think about these questions. So I say that when I hear the maturity wall, right? When people were doing deals in 2017, 18, prices were much lower, interest rates were lower. Now on the flip side, these loans are coming due. You got to pay the piper. Interest rates are high. Prices have dropped. So there's a gap, right? That to keep operating, these operators are going to have to come up with some capital. Is that what you're explaining in this potential opportunity is? Or did I misread this?
I mean, there's a lot of grease that goes into all that, but you just get into a situation where you're sizing a cash flow, right? And if you don't know the mechanics of sizing a cash flow, I'm sure your audience that's been on the banking side kind of knows what I'm talking about. But you have certain metrics, LTVs, DSCRs, debt yields, on how you size cash flow and how you size a loan relative to value. And now as values are going down, right, and you're applying that same type of LTV, well, that LTV is tightening up because banks aren't not in the marketplace anymore. They're all pulling back. They're anticipating this distress. So LTVs are getting smaller, and they're getting smaller off of lower values, right? So just throwing some numbers out there, right? I mean, you can just see how that constraint is happening, both from a value standpoint and a cash flow standpoint. And DSCRs are kind of quantified by dividing, what you can get on like a debt service or along those lines, and it kind of sizes up the loan. So you have two constraints that's really impacting the ability to retire all that cheap debt at par, and its values coming down and its rates going up. They're impacting the sizes of loans to kind of retire at those par values. So I have all the math. I fly in Excel. It actually took me weeks to put the math all together, but we have the math, and it's true. I mean, I kind of approached it from a thesis standpoint. I said, okay, I want to see if this equity gap really exists. So we bought the loans, we bought the data, I ran it through my machine. I was as unbiased as possible, meaning that when I go to size out these loans, the only thing that I'm really shocking is the reference rate. So it's that 10-year treasury. 10-year treasury during ZIRP was, zero interest rate policy, right? It was nothing, right? Now that reference rate is, I don't know what it is now, 4.8, 4.9, almost a 5 handle. I think it breached 5 earlier this week. So that impacts the way that you size your debt.
So with an acquisition mindset for the investments group out there, maybe the club money, maybe the funds out there who have been waiting for a good opportunity, like this equity gap really could produce some interesting returns for them, right? But they got to know, where should I be focusing on, right? So you're looking at these notes, and you're looking at the equity gap, and you're looking at the opportunity empirically, right? And you're saying, you're seeing some things pop up. What are you seeing where my people who are salivating for good opportunities because it's been a winter for a little bit of a deal for deal makers.
Right. And I
So
think, I'm sorry, go ahead.
no, 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 no. You go. You're the guest.
So, and I won't say who the companies are, but I'm out there talking to a lot of folks in the private equity world. And, as I mentioned earlier, the Signature Bank deal that's out to market. And all those private equity players are bidding on those notes, right? So I think the play right now is on the notes. And just because, cap rate expansion, nobody knows where that's going to go and nobody's really playing that game. But if you have an asset that's worth 100 and you have a par value that's worth 70, and you can buy that par value at 50 cents, you create an equity gap of $50, right? So, if you're on the acquisition side, you really like that basis. And I do know some private equity players that are playing around in 24-hour cities, and they're coming in at very distressed deals, but they're coming in at super, super attractive bases. So if I was an acquisition guy, I'd be calling up all the regional banks who are, excuse me, have maturities coming due and say, hey, if you can't retire this debt and your borrower can't pay you off, we're happy to bid on it. We're happy to come and get that debt off your books. So I think the play is in the NPLs, the play is in the non-performing loans. That's where I would be. That's where I would be if I was an acquisition guy.
Okay. So then walk us through the next stage of, right now, this is where you would play non-performing notes. What about the next season when all the players listen to this podcast and they're like, oh, we're all in now, non-performing notes aren't the best focus. Where do you think what's the next step that you and I should be focusing on?
Well, so as I mentioned earlier, I'm a CFA charter holder, and I still stay involved with CFA Society of New York, and we just kind of plug an event that we have coming up on November 8th. You can live stream it, whatever. But it's on this topic of infrastructure capital kind of coming into niche and esoteric asset classes. I'm excited to learn more about it because I'm not bidding on these projects, and I'm very curious to see how infrastructure money is penetrating things like data centers, student housing, charter schools, but most importantly, data centers, right? Data centers are a derivative of all the big data analytics that are out there that need processing, right? They need a home, they need a place to stay. And there's articles out there that keep talking about how, there's so much data out there. Where's that data going to be stored? So you get past the NPLs, and I have a healthcare real estate background. I mean, that used to be in vogue. I mean, that's a little bit more an esoteric asset class when you get into senior housing, acute care facilities, medical office. Medical office has become a little bit more of an institutional asset class. I do think data centers, I do think charter schools, student housing, that's been around. We're invested in a closed-end fund that focuses on student housing. I love that asset class. So I would say kind of, chase asset classes that aren't so tied, that aren't as cyclical. Chase asset classes that don't have the same type of volatility as multifamily, as office, as retail, because they're out there. And I'm very excited to learn more about data centers. I've never really underwritten one, but that's an asset class I'd love to be all over. I just have to get educated on it.
That's interesting. Why do you think student housing?
Well, I'll tell you. So student housing versus conventional, right? Yeah. Think of it as a parent, right? The last thing I'm going to give up is my college education or my students, my kids' education, right? They're going to go to school, they're going to get their education, and I'm going to support that as much as possible, right? So I do think that there's that non-cyclical component, right? It's a little bit more of a sticky asset class. Sure, it's somewhat seasonal to the academic year, but it's and there's always that premium, right? There's a 10 to 15% premium over conventional, right? Sure. As student enrollment grows, student housing will grow as well. I do think there's a lot of academic universities that they just don't have the dorms, right? So it's just kind of spilling over into off-campus housing. So if you're finding that type of product, stickier rent, again, parents are going to give up their kids' education, and a 10 to 15% premium over conventional. So I think all those things. And I look at it from the standpoint of just getting out of the cyclicality of real estate and kind of diversifying your income stream a little bit more. So that's the kind of things that we haven't rolled out our investment management business. That's down the road, but we'd love to chase those esoteric asset classes that are just non-cyclical. And a few groups that have performed that way, and the gentleman who's actually going to be on our panel is from Harrison Street. And Harrison Street focused a lot on student housing. They chased a lot of self-storage. Those are asset classes that were, just stickier. I mean, and they just weren't as cyclical as some of the, the office, the multifamily, the industrial, the hotels. It's just a different risk profile.
Yeah, super interesting. Do you mind if I ask you maybe another asset class? Like, I
Sure.
think I love your perspective on things. How do you feel about assisted living? Right. So student housing's one asset class, right? Non-cyclical, they'll pay a premium, but you have the assisted living, senior housing, which COVID decimated, right? Like potential values dropped pretty heavy there. Like,
Right.
what's your views of that asset class? Do you think it's going to come back? The population's growing. We have all these baby boomers. What's your thoughts?
Um, so just to be a little bit more specific. So when you get into, so assisted living, I want to say was a little bit more, I think performed better. So you get into the care spectrum, right? So you
Yep.
have age restricted, right? 65 plus minus. Then you get into independent living. Then you get into assisted living with memory care, and then you get into skilled nursing,
Mm.
right? So skilled nursing, those have very, very low break evens, meaning that the operating expense ratio is like 85, 90, 95%. So the ability to cushion, a downturn in occupancy is very, very low. So skilled nursing during the pandemic was impacted the most. And then as you went down the care spectrum, you had a little bit more cushion from a break-even standpoint, but skilled nursing I think got pummeled. Um, again, senior housing isn't something I chase every day. It was an asset class that I focused on significantly. But now I'm a little bit more diversified. But so assisted living, I think, will come back. I do think before COVID even happened, there was so much money that was chasing senior housing. It was just, it wasn't the traditional players like Ventas. You had Goldman Sachs and a lot of folks that kind of went into the business, and they were capitalizing all sorts of deals. And all those deals were under, construction projects, right? So yes, that gray wave is coming, but the ability to capture that gray wave into your project when 10 other senior housing communities are being built, very challenging. So I do think there's yes, COVID, you're coming back, but I definitely think there's a supply issue that needs to kind of run its course. And then obviously where interest rates are, um, challenging. It's a challenging asset class to be a part of. I have a good buddy, that's out there. He's doing a lot of more on the NPL type stuff in the senior housing world. But he does like the kind of the long-term play, but just where bases are right now in that asset class just doesn't make fundamental sense to go out there and acquire those assets. So
When someone, I'm $100 million fund, real estate fund, and I come to you and I say, we want to engage with you as a consultancy. What does that look like? I grew up in traditional construction, then real estate. If I didn't sell a building or a house or whatever, I didn't eat. I didn't get paid. Right. So what does that look like on the consulting side? I'm a fund. I want to engage with you. What do your engagements look like? I mean, you don't have to give the specific details of dollars and such, but like, what's it look like?
well, I haven't unfortunately I haven't had that engagement yet, but
Okay.
it'd be very nice to have a nine-figure fund come to me and say, hey, we need to bring you on board. Um, it's hard to speak to. I don't I've never had that immediate exposure, but we've worked on an owner operator side. Again, this is not my consultancy on the umbrella, but I do have the expertise of working with an owner operator that's ready to scale, and he wants to raise kind of a fund that is specific to. And when you say a fund, we go straight to the institutions, the sovereign wealths, the pension funds, that type of ilk. So you kind of skip the investment manager and go straight to the institution for somebody that's scalable. I think that's the challenge, is finding an owner operator that's scalable. But it's a programmatic JV, and if you raise that type of equity capital, anytime you draw equity, you get kind of paid a fee on that. There's a few folks that I'm kind of advising on that. The challenge is just, can they bring a deal flow where, you're not in a negatively levered situation. So a fund doesn't come to me. I wish they did, but maybe down the road. But owner operators that are looking to raise some sort of bespoke fund or something that's specific that can help scale their business, we do that. I've done that type of work in the past, and I'd love to do it now. I just think it's a challenging time in the marketplace to go out there and raise that type of equity capital.
Got it. So for owner operator or for operators that are looking to scale, right, and they want to raise some capital or figure out that process to scale, they engage with you and you kind of help walk through that process. Go straight to sovereign funds, go straight to institutional. Let's skip the investment managers. Let's deal with big checks, right? What for operators out there who are listening in and going, yeah, that could be me. How do I know I'm scalable or not? Deal flow is important, right? Can I continuously get good deal flow? What other things might I be needing to pay attention to as an operator?
Um, so obviously geographic presence, right? If you're somebody that wants to acquire in different markets, you have boots on the ground, you have a geographic presence in those markets. I'd say the next one is continuity of the executive team, right? How long you've been together, how long you've been executing, what's the track record look like? Um, and I'd say, when you lay out what the scalable platform is going to be, it needs to be very, very, very specific. And what I mean by that is just, we're not going to, once we allocate equity, a certain amount for this geographic area, we're capped out from that standpoint. All the deals that we work on, it's going to have a return on cost 120 to 150 basis points higher than Class A product or whatever you want to call it, whatever the asset class may be. So it's got to be a very defined investment box that this is what we're good at. This is what we've done in the past. We've built a $1 billion track record. We're going to replicate it from this standpoint. And we're going to expand in certain markets where we have a geographic presence. We have continuity among the executive team with boots on the ground. We're knowledgeable professionals. People know us. We're very good at managing properties and all those things, right? I mean, you have to be a company that's vertically integrated, somebody that's already scalable. And I think a lot of owner operators try to approach that capital where, the in-house team is small. They don't have a vertically integrated staff. And they don't have geographic presence, but they want the money. And I get it, but you have to be able to scale and you have to be able to deploy that type of equity in a 1 or 2 year time frame. Because you're competing against the folks where investment managers are knocking at their door and saying, "Hey, we're going to do a multi-billion-dollar fund. This is our 10th fund. We're able to deploy our capital. We're able to get our capital out in 36 months, and we're earning this rate of return." So that's the alternative: is that they just go into an investment manager who can deploy that capital very quickly. So it's hard. I mean, I wouldn't say it's finding. Those owner operators they're not everywhere. But if you built your company correctly and you've built it to the point where you have continuity, you have boots on the ground, and you have a geographic presence, you can do it. You can do it.
Yeah. What is the name of your podcast show? You told me this and I couldn't pull it to memory.
So it's called Apropos, right? And we talk a lot about we have the, again, a really good Rolodex where I have the ability to kind of bring on some smart folks, and I kind of get to, probe them a little bit, similar to how you're doing me. And but we talk about things that are apropos, that are relevant to finance. And we're only on a third recording, but the gentleman that we just had on was Frank Kelly, and he's the founder and managing partner of Fulcrum Macro. He's the type of guy that you spend $5,000 to go watch in a keynote. Fantastic guy, super knowledgeable. He's advised a few presidents. He's a Wall Street guy too. So we talked a lot about geopolitics and the chaos in DC. And thankfully we have a House Speaker. Now can we pass some of the bills that we need to pass before year end? Probably doubtful, but he brings in those data points that are just that you don't hear about in the media. Right. And the gentleman I had on before that was the deputy CIO for a hedge fund in New York. Super smart guy. We talked a lot about what was happening in China, our relationship. We talked a lot about, state actors versus non-state actors in some of the BRICS countries. And then we just kind of talked about what keeps you up at night. What's apropos to the conversation that we're not talking about. And he said, we're AI, AI is taking productivity to the next level. Do we have the ability to grasp that as a society, as a human race, to be more productive, produce new products at a faster rate? So we talk about these things. It's yes, it's a little bit outside just finance. It's a little bit outside commercial real estate, but it's all relevant to the financial markets. And the gentleman I had on prior to that was kind of our inaugural recording.
Yeah.
We actually talked a lot about, 6 months since Silicon Valley Bank, right? What's changed in the banking industry? Do we expect to see more heartburn? Do we expect to see more kind of bank failures? We talked a lot about that. And we also talked a lot about, which kind of led to the event where we talked about infrastructure capital kind of filling that bank debt that's not there and kind of chasing more niche esoteric asset classes. So we like to throw a wide swath out there, and I'd say kind of the next speaker that we don't have in the queue yet, but we are talking to folks. I really want to talk about data centers.
Okay.
And I have somebody that's coming on that she's a venture capital. She's a prop tech founder.
Cool.
I don't think she is, but she's coming up, and she's two female leaders that started something that is super cool. But they also had some challenges as female venture capitalists, right? They had very hard time raising capital as females. And so we want to talk about that too. We want to talk about, DEI, and so we want to have a diverse group of folks that kind of come on, talk about things that are apropos to finance. And I don't want to be constrained. If there's a topic that comes around and it might be impactful to the financial markets, we hope to have them on.
Forgive my ignorance. How do you spell that? I'm trying to find that right now.
Oh, APROPOS.
APROPOS.
Yes, apropos.
What does that mean?
Relevant, right? It's kind of relevant to the situation, right? It's apropos to the conversation we're having now, right? Yeah, I mean, just a better definition for that. I'm not Webster's dictionary, but I always the first synonym I always give is relevant, right? How's it relevant to the conversation? How's it relevant to the topic of finance? How's it relevant to the topic of commercial real estate, financial markets, et cetera?
I love it. You're looking at things that are going on in the world, things that are going on with different asset class, and how it will affect other stuff. So APROPOS, right? And that's where people could find your podcast. So I want all my listeners to go over, listen, download, subscribe, give a raving review on the podcast. Yeah, absolutely, Patrick. I want everybody to go do that. And he's currently looking for guests in the DCIM world, the data center infrastructure management, or data centers, right? Like those are the kind of people that you want to have conversations with. So if anybody is out there who could talk about that at a high level, Patrick's information will be in the show notes. Please connect with our guests and say, hey, I'd love to talk about this, give him your pitch, and maybe it'd be a good fit on his show.
I appreciate it. And
yeah,
just
absolutely.
One more plug.
Please, yeah, go for it.
I'll get back to your show, but we're now doing this as a collaboration with CFA New York.
Okay.
They have an audience that is bigger than mine for now, but we're kind of clubbing our minds together to go out. And so my point is if you come on, you kind of get the same audience that you would from a CFA society in New York, which has like 14,000 charter holders. Sure. Just in the New York metro area. So that collaboration's happening, and you'll get that audience too.
Super powerful. What's the name of your consultancy, and where can people find out more about that? Because there's $100 million fund out there who's now going to knock on your door and say, hey, heard you on Josh's show.
Let's hope so. So it's Ness and Associates. My last name's Nessenthaler, and Ness and Associates. I mean, I always kind of pluralize it. It's just me now, but we're kind of in the market looking to bring somebody on. I think I found who she is. So she's going to help with this capital raise, and super excited. She's super smart girl, and hope to bring her on. So that would be my first associate, but she come on as a partner and all those good things, and super bright, and I can learn a lot from her, and she can kind of help scale our business. But so it's Ness and Associates. There's probably a few Ness and Associates. I wish them the best. We'll probably do the best with our title relative to theirs, but and we're based here in Prospect, Kentucky. Louisville area, if you will. So I'd maybe use that in your search engine.
Yeah, very good. I know you can't share all the information because you're in the middle of all sorts of building some technologies and such that you just not yet. You can't share it with the world. Give us a glimpse of what to look for in the future, if you can.
Yeah, so this is research that we're doing at a university, and we have two blue chip data providers. We're actively engaged in the conversations with both of them about what our thesis is. And and I guess it goes back to my career and the evolution of my career, where I talked about numerator denominator, but you can also look at it from the standpoint of space market in the numerator, transaction market in the denominator. And my exposure of spending time in the space market in Dallas, it's a market with its own nuances, et cetera, in terms of operations of real estates. space users, how they behave, where they satisfy their needs. And there's a whole, there's so much research and theory that goes into that. And then I spend time in New York where you're on the transaction side, and debt and equity, satisfying capital partners, debt providers, equity providers, but they think in a different term. So it's the vision that should make sense. It should be complementary and be synergistic. It's not. And what we're trying to do is we're trying to show the relationship between the space market and the transaction market. We're trying to incorporate big data variables to help create better leading indicators than time series to predict what's going to happen in the transaction market, right? And I think there's research out there that's touched on this, and people have shown relationship with big data variables and how it impacts rents. But I don't think they've had the data partners that we have had. And one's publicly traded. One, you'll both know them, and anybody that's in the commercial real estate world knows who they are. But right now we're in the world of academia, and we're looking to establish a working paper. Do we have ideas that could turn into some product that we want to monetize? To be determined. But right now we're kind of in the thick of it for the research, and we're slowly putting together that mousetrap. But exciting things to come if we strike gold. But we're pretty excited about it. And obviously there's conviction in what we do because we were able to attract these data partners, and it's interesting, they don't like working with each other. So we actually got them under one idea, one other standpoint, and we actually had to attack one. One of them gave us like 20 gigs of data, the other one gave us several gigs of data. But the way we negotiated it was we have to attack one data set first and then the second data. We're not like merging the data. So my point is it's there's a lot of conviction in what we're trying to do. So we're excited about it.
Yeah, super cool. You're you're the middle guy bringing it all together. So it's you're gonna have a lot of fun coming on up, man. Really cool. I can't wait to see the journey of that unfold. Make sure you stay in contact with us and our community so we could cheer you on. And when you're ready to roll that out, man, we want to be one of the first to hear it and celebrate it with you. During this interview, there's probably a question that you and I discussed that I should have asked you that I did not. What is that?
I'm not sure. I think we covered a lot of ground. We were talking about our boys earlier. Maybe I don't know, goals of the family. I mean, we're super excited here in Louisville. Maybe ask me why I come to Kentucky, right?
Yeah. Well, your father-in-law's there. That's where your wife's from. He teaches law at the what school? U of L?
It's U of L, University of Louisville. It's the Brandeis School. But one of the things when I'm always talking to folks about Louisville, I'm just like, we're known for bourbon, right? And that's become almost like Napa Valley, right? For bourbon, but for brown water. And the second thing is horse racing. And the coolest 2 minutes of your life would be at the Kentucky Derby. Awesome.
While drinking bourbon.
Love drinking bourbon and love watching horse racing. But, the Derby is one of the coolest events you'll ever go to. I promise. It's up there with like a Super Bowl.
Yeah.
If you ever make it out here, Josh, please give me a ring, and we'll get some tickets and go watch some horse racing
and drink some bourbon. Funny story to end this off. My mentor, he's like a grandfather to me. He's a Derby winning horse owner. He lives in right near Louisville. He lives in Walton, and I think that's not too far, or he's more near Cincinnati. But I owe him a trip, so this trip might be coming sooner than later. I'm going to hold you to it. We're going to grab some bourbon together and watch some horses, yell at some horses.
I love it.
Yeah, cool. Well, I appreciate you coming on, Patrick. This is, man, you really challenged me to think really deep and thoughtful, higher level questions. So thank you for that, man. You put me to the test. I hope I passed. Fellow listeners out there, as always, reach out to our guests and say thank you. Especially if you could use their help, reach out to them and say, hey, I'm working on something. I'm $100 million fund, and I really could use some help with what we've got going on. Their contact information will be in the show notes. If you have a deal that you'd like to talk about here on the show, head over to thedealscout.com, fill out a quick form. We could talk some deals, do some deals, or maybe have you on the show next. Till then, we'll talk to you all on the next episode. Bye, everybody.